Welcome to the Financial Planning for Canadian Business Owners podcast. You will hear about industry insights with award-winning financial planner and entrepreneur Jason Pereira. Through the interviews with different experts with their stories and advice, you will learn how you can navigate the challenges of being an entrepreneur, plan for success, and make the most of your business and life. And now, your host, Jason Pereira.
Well, welcome to the Financial Planning for Canadian Business Owners podcast. I'm your host, Jason Pereira. Before we get started, as always, just a reminder to sign up for my newsletter at jasonpereira.ca. Now, it's today's show. Today, I have Stephanie Choo, partner at Portag3 Ventures. Portag3 Ventures is a venture capital firm that specifically invests within the fintech space, the financial technology space. However, I didn't bring her in specifically for that. What I brought her in for was to have a conversation about what venture capitalists are, how to approach them, what they're looking for, and how to know if you're someone who should be taking on venture capital. And with that, here's my interview with Stephanie. Hello, Stephanie.
Hi, Jason.
Thanks for taking the time to come in.
No worries. Glad to be here.
Excellent. So Stephanie Choo of Portag, tell us about Portag Ventures.
Portag is a global fintech-specific venture fund. We invest across seed, Series A, and Series B, but we're really looking for companies in the fintech space that are going to transform the future of financial services. So we typically invest at the stage where companies have what's called product market fit, which means they've got early traction, they've got customers, they've got some revenue, but we will often or sometimes make exceptions for companies a little bit earlier than that, where we have really strong conviction in a space or in a team that we've known for a long time. We invest globally, which is, I think, one of our differentiators. So North America and Western Europe. And finally, we've got a set of LPs that include institutional LPs, but also a number of corporate strategics. And I think one of our big pieces of value add is that we have a full team dedicated to creating partnerships. They could be commercial partnerships, distribution partnerships between our LPs that are financial services oriented and our fintechs. So really our belief is that we want to create ecosystems and connecting different players within that ecosystem will create outsized value for everybody.
Yeah, that makes a lot of sense. So you're not just about the investment portion about it. You're helping them not only do they have product market fit, but basically get the right partnerships to get their product in the market, and everybody wins. And those are also investors in the fund. So it makes a lot of sense. So the reason I brought you in is normally we talk fintech, but this is not specific to fintech. It's more so about, for lack of a better term, talking to VCs. So essentially, what is a venture capital firm, and how can the listeners who may be in a position where they might be a right fit for that basically come to a basic understanding of what that experience looks like. So let's start off again with, what is a venture capital firm? What is it you guys do specifically?
A venture capital firm is a source of capital for certain kinds of early stage businesses. And there's a lot of different VC funds that are specific to sector and specific to stage, but at the highest level, they're capital providers to generally very high growth companies that are generally also technology oriented and scalable in their business model. VC funds invest almost exclusively on what is called a venture portfolio approach, which is unlike other sources of capital like private equity. The VC market looks to make bets/investments in a portfolio. Yes, that's right. in a portfolio approach, which means that they're looking for generally billion or multi-billion dollar outcomes. And they expect depending on what stage you're investing in, 50 to 90% of their investments to fail. And it's really, they're investing on what's called the power law basis, which is a very small number of your portfolio will end up generating 90% or plus returns for you.
You're swinging for the fences every time, striking out plenty of times, but if you hit the home runs, that's all that matters, right?
That's exactly right.
Yeah, and that $1 billion opportunity more than makes up for all of the 8 companies that you bought out at the same time that went nowhere.
That's right. Yeah. And I'm generalizing across lots of different stages, and that failure rate and survival rate is going to change depending on how early or late you invest. But that is, even the latest stage investors in the VC space will say that is how they invest.
Yeah, because there's still a lot of risk, right? Sometimes it's just not the risk of the company failing. It's a matter of the company goes public and maybe they end up not making money because they bought it too high a value. We were talking about WeWork earlier, so.
Yes, that's right. It's a really high risk asset class.
Yeah. Yeah, because I mean, it's not a public market, right? So you do not have all the players in a public market creating a clearing price that hopefully is efficient. You guys are working with your numbers or calculations, making your best educated guesses, but it is one that, regardless of that, there's still a lot of risk to these businesses, and there's a lot of risk to you putting up the capital at whatever valuation you think it's worth. So it's not for everybody. We talked about who it's for. So let's talk about who it's not. Like, why would a listener who's got a business that's growing well not be looking towards dealing with a VC, or would not be a good fit for a VC?
Yeah, I think that there's a lot of, I'm a very passionate believer that you should match the kind of business that you are to the right source of capital. And venture is not the right funding source for I would say, the majority of businesses out there. If you are a cash generating, cash flowing business that is not particularly scalable and maybe not growing 100% or more year over year, venture may not be for you. And I think there's lots of great businesses out there that fit that profile that can find other sources of funding, being either debt or other sources of maybe private equity style funding or angel funding that is not suited well to the venture capital sphere. I would also say, even if you could potentially be, and as we were talking about earlier, there's certainly a spectrum of kind of what are called lifestyle businesses all the way to scalable venture businesses and everything in between. Even if you could potentially raise venture, there might be a lot of reasons why you might not want to. And I kind of explained already that venture firms, I explained a little bit of the structure of venture firms, and maybe one other thing I'll mention is that it's important to note that our LPs expect a return. So the investors that invest in venture funds want a return at some point in time. And if you want to hold your business and potentially pass it on to the next generation, or it's a business that you want to run for 15 or 20 years in your life, venture is not the right funding source for you, because they will expect an exit. A typical fund life in the venture world is 10 to 15 years, 10 to 12 years. They will expect an exit in the lifespan of their fund so that they can return capital to their investors.
It's not a multi-generational play.
That's right. So your business should ideally find an exit within the next 10 years. And that means a sale or an IPO, or a swing at the fences to a sale or an IPO, which might mean a zero.
Yeah.
And I think you will be, as someone who has taken venture capital, you will be asked to grow quickly and expected to find a way to exit and return capital within the following 10 years. And that is not what every business owner aspires to. And I certainly don't think that is what every business owner should aspire to.
No, I mean, when people start looking for the exit from day one, sometimes it's a very bad sign. And other times it depends on the nature of the business. I often say that, you guys are basically rocket fuel. So if someone needs rocket fuel because the only thing preventing them from growing that business is the capital, because they have something highly scalable and very profitable, and they're reinvesting 100% of whatever they're making, if they're making money, back into the business, you guys are the solution to that, potentially, depending on other dynamics as we discussed.
Yeah. And we will certainly ask for our companies to reinvest. So pushing to profitability at the early stages is not something that we typically are looking for.
Yeah.
So, and that again is going to sometimes be at odds with certain kinds of businesses that could in fact be profitable if they didn't
people
reinvest.
Who just can't get their head around
That's
that.
right. That's right.
Right. Like trying to say, you know what, I'm not even going to run a profit. I'm going to run a loss on an annual basis. And it's not just tech companies, right? If anyone's read Phil Knight's book on the origins of Nike, it's called Shoe Dog. And he was constantly being told by his financiers, like, start holding on to some capital. He's like, are you kidding me? I'm growing at this rate. Every penny I have is going into buying more inventory and bringing it in and pushing it out because he was growing so fast.
Yep.
He risked his company several times over. But if he hadn't, would he be where he is today, right?
Yep, that's right. And one other structural thing to note is, depending on the stage, we're looking for generally at the early stages, seed, series A, which I can explain what those categories mean. We're looking for 10x plus return on our capital. And I think that's important to note as well, because if you sell your business, if we buy a stake in your business, we're expecting at the later stage, minimum of 3 times. At the early stages, at least 10 times, often more. We're looking for the 100, 1,000 times return on our capital. And so that gives you some sense of what kinds of exits matter. And typically that's going to be in the billion range to make a fund. So there's some real structural issues at play that really drive our investment decisions, but also not only our investment decisions, but also the kinds of companies that we choose and the kinds of paths or trajectories that we expect those companies to be on. That's not to say that 100 million, like, again, if you're investing earlier, maybe $150 million exit can be exciting, but part of the issue is you will need to continue to grow and continue to meet a certain trajectory to raise additional venture dollars.
Yeah, and I've been told that by several people in that world, where the job of any VC is actually, or any VC funded company, is to get to the next round of funding, right? Like your goal is, I've taken this money in. The next goal is, I know I've got quote unquote runway, enough money to last me for X number of months based on our plan. I need to get to the business to a point where the growth is satisfactory enough to other VCs or the same VCs to give me more money to get to that next stage, and so on and so on. Yeah, it's no wonder that this type of business is more attracted to technology and software because, hey, software scales infinitely, right? It's you develop the code and it can be copied a million times over for next to no marginal cost, right? So it makes a lot of sense. So we talked about who makes sense and who doesn't make sense in terms of a VC funding. And we can give you examples, like, for example, like Joe's Pizza. I open up a pizza shop. I'm not going to seek VC funding unless I've revolutionized how pizza gets made in some way, shape, or form.
Ironically, there have been a lot of famous, recent examples of pizza shops getting funded. I would say...
Is that, okay. That's a side story. What?
There is a side story behind that. I mean, one of the latest hottest trends, which this is not my domain.
Is this the automated pizza play?
Yes. There's
that makes sense.
The automated pizza play.
Yeah.
And there's also, I would say, there are a number of cloud kitchens. Pizza being one of the easiest categories of food to actually make in small contained spaces. So
these are restaurants that don't actually have a forward-facing, frontage. It could be in the middle of an industrial complex, but they're just delivering via Uber Eats or whatever else it is.
That's right. Yeah. So they are virtual kitchens where there's no actual storefront. Yeah. You develop a brand, and there's a lot of new distribution angles out there. And because you don't have to run or manage the front of house in a restaurant, it actually becomes, quote unquote, a lot more scalable.
Travis Kalanick got into this, didn't he?
Yeah, that's his big next venture is, if you think about the logistics of Uber and what he was able to build there, I think this is a natural extension.
Moving further up the funnel. But so I picked the worst example with pizza, but that's hilarious. So you know what? There you go. Even pizza with the right implementation, technology, changing the game, that can actually be a venture fund, attracted to venture companies. So we talked about, again, who should and who shouldn't in general. Let's talk about how to talk to someone like yourself. So basically they get an introduction, they get an opportunity to speak to a VC. What is it you're looking for that company to deliver to you to make it look compelling besides the asymptotic growth curve?
Yeah, and I think it really depends on the stage of company. Every VC will look for something different, but I think there's some core fundamentals that are being evaluated. One, and the first and foremost, everybody says this, is the team. We look for teams that have a track record generally in excellence of some sort. It could be within their industry. It could be outsiders challenging an industry, but we're looking for a track record of success. Repeat entrepreneurs. We're often looking for entrepreneurs with exits. The team is, a company might pivot its business model 100 times. It might even pivot the space that it's operating in 100 times. But what doesn't ideally change fundamentally in what you're investing in is the team. So that's the number one thing that I think most venture funds will say that they look for or invest in. We then obviously look at the business itself. Is this a business we believe could eventually become a multi-$100 million or billion-dollar business? And I think a lot of factors go into that. Is this a market that we think is interesting? Is there why now? So why is this the time that there's an opportunity in this particular space? And then I would say in that as well, we look at, is this actually solving a problem? Because there's a lot of really interesting technology out there that does not solve any actual problem. And that's I think one of the big things that we look for is there a pain point that is so viscerally held by a potential customer base that this does not need to be solved, that there's just blatant kind of demand
Here,
for whatever
shut
it
up
is
and take
there
my
is.
money. It's that important
That's
to
right.
me. Yeah.
And I will pay any amount. And I think like that's one of the key things that we look at. And I think you can see that in a lot of different ways. You can see that in early customer attraction. You can see that in a group of crazy evangelists for the product. You can see that in product reviews. You can see it in talking to specific customers. And I think those are the things that we're really looking for.
Yeah, and it makes sense. I mean, a lot of that makes sense. The Ray Kurzweil specifically talks about how a lot of ideas are not bad ideas that fail. They're great ideas. The problem is that their timing is wrong, right? And if you look at a lot of the companies that are unicorns now, that's a privately funded private company that's worth over $1 billion. A lot of those ideas were ideas that actually existed back during the dot-com bubble and failed miserably. And then now the timing's right, the technology is right, the social understanding of what can be done is right. That makes perfect sense.
Yeah,
and as for
users might not have been ready previously. And I think there's a lot of examples where customers, Instagram, Twitter, I think are great examples where there were many businesses that were started before then that were very similar. But I think you end up there were moments in time in which, I mean, in our segment, I think online banking, mobile banking, digital only banks, that has kind of been the trajectory of what we've seen, and consumer readiness around being able to be willing to trust a digital only mobile first bank that this is your money. And I think the bar for trust is super high. And I think that's part of the reason why we believe that there's a generational opportunity to invest in fintech now, is the consumer readiness is there. They see the experiences that they're getting in the other apps in their phone and the other kind of areas of their life, and they want that convenience in their financial life. And I would say 10, 15 years ago, even though the internet was around,
the iPhone wasn't. No, mobile changed that game massively.
Exactly. So there's a confluence of actual technological changes, but also consumer readiness is different and trust is different. And especially after 2008, I think there's a number of reasons we believe that now is the time.
Yeah. The big towers aren't necessarily the safe thing.
Exactly.
I can trust someone who's a smaller player. And I still remember a major Canadian bank coming out with their own online offering as an online exclusive offering back in during the dot-com bubble. Like it was like late 90s, early 2000s, and so far ahead, and it went nowhere, right? And it was just like, the internet's a cool thing. Let's put ourselves on there. People just weren't ready for it. I mean, the number of people back then who would put their credit card number on a website was infinitesimal compared to now. So and I had this conversation around paradigm changes on my other podcast. And just to share a story, I've had this conversation about voice as an interface. Getting way off track here, but voice as an interface, and people saying, well, look at the stats, no one's using it, and is it really, we are used to visual interfaces. I say, that's nice, that's us, okay, but my daughter at 18 months pushed the button on my Apple Watch and started going blah, 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 blah. And I was just like, okay, she's growing up with voice as an actual UI. And to her, just shouting it out is going to seem like nothing. And my son loves giving, my HomePod or my Alexa, just triggered a bunch of Alexas, just basically loves giving them instructions on playing music or telling jokes or whatever else, right?
Yep.
So that's the same kind of an example, right? Takes almost a generational change to get used to that. And I think, what you guys have done is smart, because your timing is quite nice on that. So you look at the team first and foremost. People behind any business is always the most important thing. You hear these stories about companies getting funded off a slide deck. And I like to say more often than not that usually doesn't happen. What is it you're typically looking for from them at the time that they sit down with you, behind the people?
So just to make a comment on the slide deck, that rarely happens.
Very rarely.
And again, I don't want to generalize, because there are some founders that are able to do that, and that might happen if you approach what is typically a pre-seed fund that specializes in investing in teams. And again, we're looking for some very specific things that will happen. You increase your chances of that happening if you are a repeat entrepreneur with an exit. Then yes, you can absolutely raise capital.
If you're one of the PayPal mafia who's done this twice now, right. Like you're gonna get, oh really, you're doing something new? I don't want to see the slide deck. Here's the check, right?
That's
in
right.
Some cases.
And I think there are a very small number of people who can do that. And
yes.
It is absolutely true that it happens, but with a very select few people.
Exactly.
And I think we're looking for, as I mentioned, so team, I think we're looking for something that solves a very specific pain point or problem, which can manifest, which like, again, we can see via product metrics, revenue metrics, customer engagement metrics. Those are all things that
it better
we're
be
looking
done.
for.
There better be something done and proven in terms of a use case.
Generally, yes. Generally, we're looking for, at the stage that we invest in, and again, there's a lot of other companies that invest in different stages. We're looking, if you can't show some reason why your problem, why your technology or whatever your business should exist and why it should solve a problem, I don't think it's going to be easy to find an investor. And then I would say, typically we're looking for a kind of a market or a business that's going to have a trajectory to being a large business. And that generally means there's something scalable about your model. And if we can't see that, then it's, again, very hard to attract a venture investor. So there needs to be a compelling story behind that about why you think this can scale to be a $100 million revenue opportunity without being, and again, there's different kinds of venture funds. We're typically looking for an capital light business models, which is what a software company is. So,
they're not buying giant factories or anything like that. They're,
right.
They're employing guys on a floor or people on a floor that are basically sitting there in front of computers and they're just punching away.
Yes, there generally is a strong technology component to whatever business it is. Although again, there's so many exceptions that have been and are still venture funded. All of the consumer venture platforms, which are direct to consumer brands, a lot of them have raised a lot of venture dollars that are valued over $1 billion today. And that sell X direct to consumer contacts, glasses, suitcases.
Many of these things are all things I order online myself from companies like this.
What have you?
Weighted blankets lately. Yeah, I've seen this.
That is also a big trend. And I think all of these purport to have some technology underlying why they could be venture scalable. I think we haven't seen that many exits yet. So time will tell if these will be venture businesses. I think the truth is if you invested early enough, you're probably fine. But that is a trajectory that we're looking for. And I think it's often underpinned using technology, but that doesn't necessarily mean that it has to be a technology first or technology only company that will attract venture. Yeah,
sometimes it simply is, I'm going to sell X on the internet in a different way by using what are models that other people aren't using traditionally.
That's right, to attract or acquire a customer. And that there are venture capital funded businesses that.
And we talked about Casper earlier. I mean, company that sells mattresses direct to your door and does so online and predominantly got its basically recognition through social media marketing, podcasts, all of it, stuff that traditional mattress companies were just not doing, right? Or just not doing as effectively.
And I would say that their innovation, they would say, happens on the marketing side, which you've already identified, but also on the supply chain side, because they've been able to really, they would say, cut costs by going direct to factories, cutting out the middleman, cutting out the storefront costs. So by going direct to consumer, there's many different steps in the value chain that they've been able to cut out, which has allowed them to provide at least similar style product for a fraction of the price. So
one of the things a fintech funded enterprise said to me once was, when he's talking about what he learned about in this entire process, he goes, I don't think I started off respecting the venture capitalist money the way I should have. They all hear these stories about the pitch deck sold companies, right? And they think that, okay, these guys are just going to, you're willing to lose money on 8 out of 10, take a flyer on me. And it's not that, right? It's exactly what you're saying is that, no, you have to have proven something. You have to have proven that it's already got some sort of fit and that there's massive potential. So,
and I would add one other thing, which is also important as we talked about the example of mattresses being sold online. I think the moat, that's another thing that I think a lot of people end up looking for. So what do we mean by that? It means what is proprietary or what is protected or defensible about either your business model or your actual product, because you can be a big scalable business, but you could be inundated very quickly with competitors, which will drive your pricing and power down and put you into a commodity business eventually. And we've seen lots of examples of that too.
Casper's a perfect example of that. There's so many online mattress companies now.
It's quite easy to be a Me Too. And I think one of the double-edged sword of technology is that it's advanced to such a rate that you could build anything actually pretty quickly with a good team of engineers. And my personal belief is that brand brand actually is defensible. It's just very capital intensive to build.
Yeah, it takes some of the businesses you've invested in, such as Wealthsimple, spend a lot of time on marketing, and it's about being that top of mind default to people, right? And it's it is brand is defensible. Coke has proven that.
Yes.
Like Warren Buffett talks about moats all the time, and again, he says I could take the valuation of Coca-Cola, start a new company, and I would never be Coca-Cola because I don't have the name and the recognition and the brand of it. So yeah, very important. So when we get to the term, so you guys decide that you want to basically invest in something. What does that negotiation look like? In terms of, let's define what a term sheet is and what goes into that, and then what besides price and percentage are being negotiated in this conversation.
Yeah, even before I get to that, I want to make one more quick
point.
What?
This is hilarious because so often on this podcast, people are like, you jump forward a little bit too fast. So by all means, correct me.
Just one other point that I probably should have mentioned earlier. Before you go sit down with the VC, you should probably have done a little bit of research on what it is that they focus on.
Yes.
I only invest in fintech. I get a lot of inbound pitches for things that are not in my field.
Just scattershot. Yeah.
And you just look at their portfolio, understand what it is that they do, understand if they have a competitive company in their portfolio.
True.
That might preclude them from investing as it is. But I think understand if they invest in the stage of company that you are. And it's always good to meet people sooner rather than later, but and build a relationship with them, but have some cursory research done would be the other thing that I would say. Now, going to terms, I think the negotiation is, I would say, pretty, can be pretty standard. There's a pretty standard set of CBCA documents that most funds will use. So key terms, obviously, number one thing is price, which impacts dilution. So how much of your business you own. That is obviously the most, I would say, the headline thing that people end up negotiating, or companies and venture funds end up negotiating. There are a lot of philosophies on this. A lot of people will say, take the right partner because it's like getting married. It lasts longer. This relationship lasts longer than
some marriages.
Yep. I would say board structure and governance is another big part of the negotiation so who ends up on your board?
So oversight control is a big part.
Oversight and control. So what the board ends up what rights and privileges the board actually has, what consent rights the preferred shareholders have. That ends up being probably the second most negotiated thing in the term sheet. And then the third, which kind of goes to part one around price, is the amount that you're raising, and what the structure of the amount of capital, the total amount of capital, and the minimum and maximum amount of capital that can be raised in a given round ends up being part of the mix as well. I would say those are the three most probably negotiated things. And there's lots of there's
tons of other terms.
Terms and minutiae, but.
Yeah, there's a few books that people can read if they're interested in this that I'll attach to the show notes. So basically that covers off a fair amount there and provides some guidance there. What else should people know when dealing with VCs that are just kind of misconceptions or misunderstandings that people have? Yeah,
it's a good question. I think that we've talked about a couple of them already. One of them is I can go and raise on a PowerPoint. I think the second is it takes a lot longer than you think. And we tell even our companies that have gone through this multiple times, sometimes there's an amnesia that comes into play, but give yourself 6 to 9 months runway. You never want to leave it too late. It takes a really long time, and it is highly time consuming. Even if you've gone through the process once, even if you already have a relationship, I think a lot of people don't realize how much effort and time it takes away from actually running your business. That's another reason not to take venture funding, by the way.
It's the distraction of it, yeah.
It can be a massive distraction, and it often requires a full-time person thinking about fundraising. And that's lots of time that you are meeting with investors and pitching. That's all time that you're not spending working on your actual business and growing it. And I think it's a big challenge that founders have, is to balance the two, because if you're spending a full year fundraising, that's a full year that you're not growing and managing your business actively at a day-to-day level. So I think that's it is a grind and it's not necessarily a super enjoyable experience all the time. But at the same time, I think you only need one yes. Or sometimes a few yeses. So,
or at least one big key yes that other people are going to say, if they're in, I'm in, right?
Yes, exactly. Yeah. And that's another great point, which is I would spend as much time as possible upfront finding people who can lead and who are willing to put a term sheet down. Because finding followers is pretty easy. Finding a lead and somebody to take conviction in your company and set terms is going to be difficult. So
yeah, especially when certain funds get to certain levels, it just becomes almost a default for other ones to say, okay, if they're in for this much, we're definitely going to tag along, no problem.
Yeah, right? Exactly.
It's you've done all the due diligence work, I'm in. But yeah, it's a funny, just from personal experience, talking to founders that I know, just saying, hey, let's catch up for drinks or whatever it is, and they're like, I'm in the middle of a funding round. I'm like, okay, so when you hoping to close? Like 3 months. Okay, I'll talk to you in 4.
Yeah.
Like they may, and then you talk to them. It's like, well, I've got about 24, 36 months worth of runway. So I get to work on product for the next 12 to 18 months. And then right after that, I'm back on the parade trying to basically raise more funds for the next round. So yeah, it's time consuming.
Yeah, most definitely. And I would say, again, it's not for every business.
No.
And that's one of the key considerations that I would make if I were in the shoes of an entrepreneur trying to consider if they should run after venture funding or not.
Yeah, no. And there's other options out there, as we discussed. There's private equity, there's search funds, which I'll hope to talk about in a future day too. But it's definitely, frankly, if you're the right kind of business, partnering with people such as yourself is frankly trying to get to where you want to get as fast as you possibly can before someone else gets there. It's going to require the right partnerships.
Yeah. And there's also bootstrapping, which is using your savings to get to profitability on a business. And I think that's the old-fashioned way. That is the old-fashioned way. Yep. And I feel like there are great businesses that end up having fantastic exits that start that way as well. So,
I know the number of business owners that are sitting on multi-million-dollar enterprises, not billion-dollar, but they get into the 8 figures and close to the 9. And it's, they started with their own bare hands out of their house, right? Like it happens, and it can't be underestimated how much work that is. And yeah, so it does not need to be fast and highly scalable. It can be highly successful otherwise.
That's right.
Yeah. Excellent. So thank you very much for taking the time. Before we go, where can people find you? And hopefully only bug you with ones that are fintech based that you're looking for, that, they listen to this entire podcast and they're like, I'm a fit for that.
Yeah. So if you're a fit, so you can find us on a number of different channels. Mm-hmm. So we're on obviously LinkedIn and Twitter, and probably the best way to reach me is just to shoot me an email. So we've got an info box at info@p3vc.com that we monitor very regularly. So if you've got an interesting company, please feel free to reach out.
Fantastic. Thanks yet again.
Thanks, Jason.
Take care. So that was my interview with Stephanie Choo of Portag3 Ventures. I hope you enjoyed that. And if you are a company that's highly scalable and in the fintech space, you're definitely going to want to reach out to them. Until next time, I'm Jason Pereira. Take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals, business owners, and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on Apple Podcast, Stitcher, Google Play, Spotify, and SoundCloud. For more episodes, go to jasonpereira.ca. You can even ask Siri, Alexa, or Google Home to subscribe for you.